Hello everyone. Today we have Professor Jeffrey Wurgler, I hope I didn't mispronounce that, the Nomura Professor of Finance at NYU Stern. Nice to have you here, Jeffrey.
It's my pleasure.
So, Jeffrey, a few weeks ago I came across your paper on investor behavior, and I was fascinated by it because, first of all, you guys did something that's methodologically very, very clever. You looked at people's browsing behavior. And secondly, you established quite a few very interesting facts about individual retail investor behavior. I think the one that caught the most attention was that the average investor or the median investor spends about 6 minutes researching, or maybe 6 seconds researching a trade. So I thought that was a very, very interesting paper on what seems to be becoming one of the most important features of modern, trading. It's just a lot of retail-driven behavior. So I wanted to ask you a few questions around that. First of all, how did you guys even get the idea of looking into this data?
In academic research on investor behavior, individual investor behavior, all we really have are stereotypes. Each of us only has our own intuition, introspection, or what might be called casual empiricism, which is just another way of saying I generalized my own experience to a bunch of nearby people, and they probably do it the same way as I do. We were interested in going beyond the assumptions of finance models and just stories and stereotypes, and really digging into what is the sort of information that people actually gather, they actually see, actually think about before they make a trade. Because if we want to understand how people's portfolios come together, we have to understand those individual trades. And to understand how those positions were acquired, we have to understand kind of a little bit of the thought process and the information gathering behind that. These days, and it was true in my 2007 data with my co-author Tom Laritz, who is another colleague here at NYU, these days most of that research is done online. Not so much reading the Wall Street Journal or Morningstar research as things might have been done decades ago. So internet data, internet research has the advantage that you can get pretty detailed information about what an investor was looking at from the actual text, browser history that is recorded within your browser, seen by your internet service provider, your employer, various other ways of, seeing your click stream, so to speak. And so those data are what we acquired and studied in order to get a more accurate picture of what are people doing before and perhaps shortly after they make individual stock trades.
Processing that data must have been, and trying to get interpretable results out of it must have been a pretty difficult task. How did you guys go about it?
That's an understatement. This took years. And in fact, the panel data set that we are using, panel means many, many investors over a long period of time, it was so big that you needed specialized software just to open the data set and look at it and see this person this time went to this website for this many seconds. And so you multiply that kind of complexity by 8 million rows of kind of observations or browser clicks. You might just think of it as that. And every website uses a different structure for recording this information. A trade might be recorded in one way at Schwab, another way at E-Trade. A stock quote might be presented in one way at Yahoo Finance, another way at MSN Money, and so on. So there's a lot of sort of site-specific, boring, tedious data cleaning that go into a research effort like this. But what comes out, why it quickly became clear to us why this hadn't been done before, because it's really a horrible thing to get the data together. But now that we've got it, we've got some interesting insights.
Yeah, I mean, I've worked with this type of data before, and I can appreciate how difficult it must have been to put all of this together. So once you managed to clean up the data and start looking at patterns and behaviors, what were the things that you were looking out for? What were the things that you were most interested in consumer behavior during trading?
So broadly speaking, we wanted to characterize what kind of information set people had in mind as they approached a trade. So the way we did that is we looked in the data, tried to figure out exactly when an investor made a particular trade, buy, sell, how many shares, what price, and so on, and then look shortly before and shortly after, or as far back as we could and as far forward as we could in a couple of months. What was that person doing with respect to research on that particular stock or other stocks that were not traded? So there are a number of different dimensions of that characterize that kind of information acquisition process. What stocks are being studied? What are the commonalities of such stocks? How much time is spent researching stocks before trading them? And you already mentioned that. By the way, it was minutes, not seconds, but for some people, it is just seconds. What are the websites people most commonly rely on to gather information? You could really see what types of information do they gather. Is it earnings information, risk statistics, dividends, and so on? So really, we were interested in describing the whole context of information gathering around individual investor trades. And the internet is a great place to do that. Data set like this is a great place to do that.
Yeah, if you can manage to clean it up, it's a fantastic data set because you can see exactly what people are looking at and thinking. One of the things that I read in your paper that I thought was very interesting was that one of the primary motivators seemed to be the price action and looking at the price and historical price and charts. I work at a brokerage company and spend a lot of time thinking about when people are going to trade what. And so far, in my experience, the number one thing that drives people is favorable price action. So it's interesting to see that reflected, that seems to be a constant over time.
For sure. I mean, it kind of caters to the lowest common denominator of researchability. We understand stocks, we want them to go up. And if we see a picture in which the stock is going up today, well, that's more satisfying than something that's flat or something that's slightly down or all over the place. It's just kind of the most raw, basic investment dimension you could imagine. Of course, past performance is not predictive of the future or whatever the disclaimer, or however you want to put it. So it's, in a sense, quite interesting that we would focus so commonly on such a kind of a narrow dimension, while very important, obviously, in some way. In some way, it's a very narrow dimension of research or information to sort of take in. And it's not like you as the investor are the first one to think about this price chart, right? It's not like you have a better ability to read it than millions of others. There's kind of something a little bit delusional about staring at a price chart, squiggles up and down, and sort of thinking you can predict the future better than most others.
Nevertheless, that's one of the main drivers of investing behavior. If something has gone up a lot, then people want to be able to follow in.
Sure thing. And one of the interesting things that we saw in the data, and the data were rich enough to actually allow this sort of thing, is when people were clicking on a price chart, sort of drilling down into that, the most common look back horizon was just a day. This is the intraday price chart. If you go to Yahoo Finance right now and you pop in NVIDIA or Apple, it will show you what happened today, unless you need to clear your cache or something, or you have a cookie lying around for that. It will show you what happened today. And that is the most common thing that people do when they go to a price chart, is just look at what is the default look back horizon for the website that they happen to be on. And this is despite the fact that the vast majority of investors in our sample are buying a stock which they will then hold for at least several weeks. So why is it so important what happened today? Wouldn't it be at least as important to look back a couple of weeks, under kind of the theory that I know how to read price charts, which I don't believe many people do anyway.
I wonder whether holding duration has to do with whether the trade has gone in their direction or against them. Because one of the things that I've noticed looking at similar data is that retail traders tend to cut their winners a lot faster than they do their losers. In fact, in the data set that I'm most familiar with, most retail traders, they win on the majority of the trades, but end up losing money overall because they simply compound their losses. So I just wonder whether, they get into these trades thinking it's going to be a short-term thing, but the market moves against them and it ends up being not that much of a short-term thing.
That may well be true. And to the extent that they had an investment thesis that was just built on, I saw this price chart and it looked like a good deal, then they might be prone to those sorts of decisions. Whereas if there was an investment thesis that said, this has attractive risk characteristics, this is a dividend yield I want, I understand how this works given my tax situation. Okay, this is a growth company. I know I'm going to have to wait a while for growth to materialize. That is the sort of level of analysis that we don't often see. And that would hopefully translate into a more sophisticated, nuanced, kind of holistically rational investment policy. But we don't see a lot of that. Instead, we see what you were saying. People hate to realize their losses. It's very painful, that sort of thing.
Why do you think people don't look at risk statistics? Is it because it's hard to understand? It's a lot of work to do. Why do you think, what are the main reasons?
I think so here at Stern, we teach our portfolio theory classes to some pretty sophisticated students. After a while, it's still hard to explain some of the basic risk statistics to them, like beta. Everybody's heard of beta, but not a lot of people understand exactly how beta plays into their portfolio. When I looked at an older snapshot of, the Internet Archive, when I looked at the old definition on Yahoo Finance of beta, it was incorrect. So even Yahoo Finance hadn't really taken the time to kind of get it right. It just was generally like higher beta means riskier. And that, I think it's improved a little bit, but not by much. So I would guess that people come into an investment with a rough assessment of risk based on how much upside they see in some kind of informal way. If they look at the price chart and they see a lot of movement, then they think, well, this must be risky somehow. But as far as a sophisticated dive in the way that a textbook would have you do, or an institutional investment manager would have you do, is just almost non-existent among the research behavior of individual investors. Almost non-existent.
Yeah, I wonder if that's going to change with AI, because you can use some really great deep research tools. But we'll come on to that. I was wondering if there's differences in behavior that you see depending on the type of investment they're making? I can imagine there are some differences. If you're going to invest in Tesla, maybe it's a less considered purchase versus maybe a slightly more boring index fund or something like that. Are there differences that you see depending on the investment?
We see differences depending on the investor.
Okay.
And the investor, and very much along the lines of what you're saying, investors will focus on different sets of stocks, have different habitats. Some are trading the Teslas and some are trading, a public utility with a very long, kind of boring history. And different types of research will be done by different types of investors in accord with the sorts of stocks that they trade. So someone trading a lot of risky stocks, a lot of price movement, a lot of stocks that are in the news will tend to, they'll focus on price charts, they'll focus on the news stories, message boards, whereas those who are stereotypically on the other side, investing in more bond-like stocks, dividend-paying stocks, well, they're drilling down into the dividends and fundamentals and much less likely to just rely on technicals for their research background.
Is it fair to say then if a company is in the news for its earning calls or something like that, then a person or an investor is more likely to invest in them, even though it has nothing to do with the actual value of the company?
It is, I believe that's true. What we show in this paper is that people are more likely to do research on a stock that is in the news, overwhelmingly so. Certainly much more so for large stocks, but also news events like Apple's introduction of the iPhone happened within our data set, happened within the time period of our data. And that gathered an enormous amount of investor attention that we could extrapolate from what we saw in our data and just infer that millions of individual investors were paying attention to Apple in a investment relevant way, digging down into on their Yahoo Finance or whatever, their brokerage account, doing actual research on Apple stock, not just going to the website and saying, wow, this is apple.com product, looks really cool. It's amazing to think the degree of individual investor research attention that can be focused when there's a sort of galvanizing or attention-getting event.
Yeah, let me just add to that because I've got a data source that might be of interest to you as well. So I can see what people at our brokerage type into the search bar when they're searching for products, and you'd be amazed at the sort of things that people are looking for. If there's a football game, they'll put the name of the country. If the iPhone launched tomorrow, they would be typing in iPhone. When there's geopolitical events, they type in the name of the country where the event happened. People are very clearly driven by what is salient, what is in the news, common brands that they're familiar with. Whenever there's an IPO of things that a lot of people use, for instance, OpenAI is very popular now. There's a tremendous amount of interest in OpenAI. But even things that aren't as hot as AI, like Klarna, for instance, is aiming to IPO this year. A lot of interest in things like that. Basically, consumer brands and news that consumers like to read about are a very important driver into what even enters retail investor attention.
Absolutely. And we see some of this in our data as well, although it sounds like you see even more of it. At the time of our data set, Sirius and XM were merging, and Howard Stern had had a contract, I think, with Sirius. So I think in the absence of that contract, nobody would really have known at the time, this is a very small radio station, specialized format. But sort of having Howard Stern there primed attention to this merger event, which most people, these were relatively small companies at the time, and focused a degree of investor attention on small cap stock, only $5 billion at the time to sort of vaulted it up and up with the Ciscos and the Apples for a brief period as to how much information, investment relevant information, people were staring at on this little stock. And actually, it stayed at a high level of research attention for quite a while. That's something interesting, is that the attention is kind of sticky. And once you've bought a stock, you are suddenly far more interested in it in a relative sense than most others. So sort of this attention news has a persistence beyond its sort of short-term life with respect to investor attention.
Yeah, I think there's definitely a story to be told there, that depending on how long you hold the instrument for, your research horizon broadens a lot, right? And you think that one causes the other. You think that it's people doing lots of research that enables them to hold an instrument for long, but maybe it's quite often the other way around.
Yeah, that's a good point.
I wanted to ask you, what do you think the impact is on, because this is very micro level behavior, this is the behavior of individual investors. What is the macro level impact on markets based on this manner of retail investor trading, particularly taking into account that retail trading mania has, if anything, become more of a thing in the last few years?
So what our research contributes to that question is identifying the characteristics of stocks that really draw investor attention. What do investors not care about? It's kind of complicated, boring things like balance sheet and cash flow statement and beta. What do they pay attention to? Price charts, recent returns. So to the extent that investors are all following the same playbook, that speaks to their macro, their aggregate behavior. One, just as a different sort of example, by far the most commonly used investment data website is Yahoo Finance. That's true today. It was true 18 years ago, and it doesn't seem to be dethroned anytime soon. So depending on what is served to you on Yahoo Finance, that's served to pretty much everybody, or at least millions of people. And so that is what is going to drive investor attention for many, many investors, whereas something that just comes out slightly below the fold in newspaper terms, or at the bottom of the page, or off of the second page, or 3 clicks away on Yahoo Finance, well, that is not concentrating investor attention in the same way. So that's another thing you learn from looking at this data, is sort of, where are people going? And they're all going to the same place. So that place becomes very, very important.
I think one thing that has perhaps changed since the data was collected is the rise of social media, right? So this was, if I remember correctly, pre-Facebook. And as we saw in 2021, influencers, Reddit, increasingly TikTok and similar social media platforms are one of the main sources of investor information. Do you think that will impact investor behavior just as much as Yahoo Finance does?
I think, first of all, you're absolutely correct that our data are pre-social media. And I think there are nonetheless, at least in our data, some people who spend a lot of time on the social media of the day, which were message boards and discussions, which not much different than kind of a Wall Street bets kind of. So there is a subset of individual investors who are very focused on getting data from that sort of venue. I wouldn't say data, I would say more rumors and chat and however you want to characterize it. But I think a broader set is still interested in actual data that you can only see on a place like Yahoo Finance. And ultimately, when you go to make a trade except on some very superficial platforms, you're kind of compelled in the course of executing the trade to at least look at some statistics on the company, some kind of snapshot. And maybe it's just for the broker to say, look, I showed you. Whether you care or not, I at least showed you before you made this terrible trade. But so there is still some data being presented to investors, even for those who really might not be interested. But certainly it's become more and more the case that there's a segment of the individual investor market just probably less interested in doing traditional research and following a different pattern.
Do you think that there's anything that brokerages or apps or regulators could do to encourage a little bit more thoughtful behavior, or are people just going to behave the way they always have going forward?
I'm sure people will behave as they always have, but I'm of a couple minds about this. Okay, so in business school, we teach that it's very hard to beat the market. And the most sensible thing to do is just to, in that world where you can't be better than average persistently, is just to be sure that you're at least average and hold an index. Almost nobody follows that to the T, and everybody in our data set is actually, to some extent, deviating from that and trading individual stocks. And then there's another school of thought that says, well, it's kind of complementary, which is that you could just throw a dartboard at the Wall Street Journal and pick a stock and you'll do as well as average. And in that world, that also has the implication, like, don't spend a lot of time on stock-specific research. In fact, maybe 6 minutes, maybe half an hour is just too much.
Yeah.
But one thing that is undeniably clear is that if you're going to trade individual stocks, you should at least understand the risk characteristics of them. You should at least understand the tax implications of the dividend yield. And anything that focuses investor attention on that sort of stuff, which granted is not as interesting as just a price squiggle on a price chart.
Yeah.
I think that would be a proper role for regulation or nudge to take. Having people dive into analyst reports, I don't know if that's something we want to nudge anyway, because I don't think most investors will have any particular advantage in reading those. But it's a good question. Good question. Really hard questions.
Yeah, I'm in two minds about this as well, because on one hand, if you take the thesis that everyone should just buy the index fund, well, if we take it to this logical extreme where everyone does just buy the index fund, then what you end up with is a market that is static and is basically determined by how many people are saving money versus retiring and spending money. But on the other hand, if it is the case that the market is increasingly being driven by one, index funds, and two, retail investors buying whatever comes up on the news, then you end up with a very strange situation where maybe professional money managers are going to spend less time thinking about risk metrics and more time thinking about what retail investors are going to buy next.
I imagine that they're spending quite a lot of time on that already. I think you could go back to John Maynard Keynes' general theory. And in that book, I think it's chapter 7, where he has some wonderful observations on investing, and it's just so much of modern finance is foretold or predicted by a chapter in his book. And he writes of traders who, well, first of all, there are the people who just think they know. And then there's the people who trade on what others think they know. And then people who trade on others thinking of the others, thinking of the others, thinking of the others, to 5, 6, 7 degrees of separation. So at least in Keynes's mind, and he was a famously good investor, by the way, he enriched, I think it was Trinity College, Cambridge, quite a bit through their endowment. He was thinking along those lines. And I think what we see in our paper, by the way, is you could go to Yahoo Finance and drill down and see What are the opinions of sophisticated others about this stock in the form of analysts or insiders or, who are the institutional investors in this particular name? A lot of people don't seem to do that. They have data in front of them on what is the interest in this stock by people who clearly know more than they do, but they often disregard that. Whereas there are people trading against them who are thinking very, very hard about these issues and anticipating their own retail trade flow and so on.
Well, I guess the counter argument is that in 2007, 2008, a lot of these experts and analysts probably didn't do that great themselves either. So maybe some measure of skepticism is warranted from retail investors. But on the other hand, I appreciate you might not quite have the samples for this, but did you end up being able to get some sort of metric of some sort of correlation between the amount of time people actually spend researching and their performance? Because if the research itself is going to be looking at price charts, then maybe you're better off doing it for a minute rather than 6 hours.
That, Boaz and Alex, that will be the topic of our next podcast, because that's the paper that we're working on now.
Oh, very interesting.
Is more research better, or is it a waste of time? But now we have gathered the data, we have characterized the research, and, well, what do you think? What do you think we're going to find there? I have my own idea.
I suspect that if you just look at the raw numbers, I suspect you're going to find a negative correlation. And I think that's probably because a lot of people spend a lot of time doing research once they're already in the red. So once the trade has gone against them, they'll probably spend a lot of time coming up with excuses for why they're there in the first place. But if you maybe just segment it to pre-trade and, research, given the quality of the research, and given that you're basically...
We just lost Boaz.
I think we lost Boaz.
Just as he was about to launch into a question. We'll wait for him to come back. Luckily, we can edit all of this stuff, so let me send him a message.
He got excited and hit delete.
Hopefully he's not got charging issues. I'll give him 1 minute or two.
I can wait, don't worry.
Okay, good. I was going to ask you when we get back to it about, have you been using any of the deep research tools and the AI tools?
At the time we started this paper, they weren't developed enough to really be helpful.
Sorry.
Yeah.
But I think they would have sped up the research process quite a bit had we been more aware of them at the time.
For sure. Boaz, you about to ask a question or make a point?
Yeah, I'm sorry, guys. I don't know what my internet just broke. The point I was going to make is I think if the quality of the research is low, and if everyone's basically looking at the very same charts after reading the news, I actually think you're probably a lot better off just buying the instrument the moment you first think of buying it, because you're basically going to get in ahead of the herd. But that's just an intuition, and it's probably not always the case.
I don't want to prejudge it. I'm an academic. I don't have a horse in the race. And my suspicion is that people who do a lot of research also tend to be those who trade a lot. We know those who trade a lot tend to underperform based on other work. They get overconfident. They just do the wrong things. I wouldn't be surprised if there is a flat or slightly negative relationship between how much research is done and the performance of those trades. But we'll do that on a future podcast.
Is there any kind of bias between those who have absolutely no data which you're able to capture at all? Because are these people the ones who perform the best, where they just stick it in index funds in 2001 and they check in on it in 2025?
We certainly don't know what people who are not in the data are doing, but a beautiful thing about this particular sample is that it is representative sample, representative of U.S. households. Now, is it perfectly drawn at random? No, but it's balanced with respect to age and income and geography and all the things that a data gatherer could do to sort of get a handle on what is the average behavior. So I think we got a pretty good handle on what's going on here, broadly speaking. But certainly there's information that we can observe that qualifies some of the stuff that we're doing.
When you started out, did you have some kind of hypotheses in mind? And then when you actually saw the data, you were very surprised by the findings. Are there any things that stand out to you?
Well, you know, what I think is interesting for a reader of this research is to look at what other people are doing and to locate yourself within that distribution. Like, there are some people in this data spending a lot of time doing what seemed to me, and this is just my own personal judgment, wasting their time. Just drilling endlessly down into price charts of every horizon, comparing every stock to every other stock in a seemingly ad hoc way. And I don't locate myself near that. Okay, I also don't spend 6 seconds. I don't spend 5 minutes. I am spending, what is a respectable number? To know 30 minutes, 40 minutes, to make some significant decision where I have to live with the consequences on thousands of dollars for a while. I'm going to take a little bit of time on it. So I think everybody would find something interesting from the perspective of, oh, that's what others do. I don't do that. Should I be doing that?
Yeah.
But I didn't know whether the number was going to be this many minutes or 20 times this many minutes, because I only have my own experience to go on.
Yeah.
And I think of myself as reasonably sophisticated, but all that means to me is that I know what I don't know.
Yeah.
And that's a lot.
Yeah. This is the reason why whole research departments exist. There's a difference between what people say they do and what they actually do. And sometimes a big difference is you're discovering. I've got 2 more questions. Have your behaviors as an investor changed since this research? Are you thinking, oh my goodness, I can't do this in 6 minutes. I need to take a little bit longer now. Or actually you haven't changed at all?
You know what? I haven't changed at all. If a product of this research, if this research became wildly successful in the sense of changing people's behavior, boy, I don't know if that would be a good or bad thing. Do I want them researching more or less? I want the bad ones researching. Well, do I want the bad ones researching more or even less? I might as well save them the time. No, so my behavior has not changed.
Last question. Are there any common misconceptions that people have when they read this paper, like wrong conclusions that they take?
Yes, there is a tendency to boil a natural tendency, to boil what is a complex mosaic of numbers and statistics, and some of which are boring and some of which are more exciting, down into one number. And that is the 6 minutes. But I think if you're just going to take one number away, that's the number to take away. The median investor, half do more of this, half do less, spend 6 minutes on internet-based research on the stocks that they trade.
I've got one more last question for you as well, just out of interest. If you could get access to any data from reasonably large brokerage, what would you ask for? What would you be most curious to look at?
Boy, it's already creepy enough to see people's browser histories, okay? So it already feels like very much a big brother. But if I could get even more along these lines, but I couldn't get into people's heads, but I could get close. I don't know what people are actually thinking when they see what's on a page, but something that researchers have done is to do sort of eye tracking software. When you go to Yahoo Finance, there's 500 things going on that page, right? Where is your eye drawn? Well, I don't know. But if I knew, I could tell you a lot more about what's going on in the investor's head before he or she makes a trade. He was looking at that. No, he was looking at that. And right now, all I can see is that you are somewhere on the page. So does that seem creepy? Can your company get that?
So you want to look at what people actually look at on the page.
Yeah. In addition to knowing that you went to Yahoo Finance and looked at Apple, it's a complicated thing. There's so many things on that page. But just because you asked, I don't actually want to do that. This is quite an effort.
Fair enough. I do wonder whether there's something about the individual themselves that tells a story, and whether if you slice it and dice it between the successful individual and the non-successful individual, whether you end up with very different patterns or actually very similar patterns. But I guess that's part of the topic of your next paper.
Yeah, I guess in addition to eye tracking software, it would be nice if I or a research assistant, preferably, could just sit there and say, what are you looking at on this page? And what are you thinking? You know, this is a complicated page. Do you understand what this cash flow statement is saying? Do you understand that revenue and income are not the same? Just to get a sense of the level of understanding and how data are being processed by individuals into beliefs, into trades. That's still sort of to be explored.
Well, a good source of data for you perhaps is that under EU regulations, people are increasingly required to fill out questionnaires when engaging in some sort of trading behavior. And I guess the answers that individual investors that come with the intent to trade, the answer that they give to these questions might be interesting to you. Okay, Jeffrey, thank you so much for your time. It's been a great conversation. Thanks a lot for spending an hour with us.
My pleasure, guys. Thank you.